Unlock the secrets of debt. Understand interest rates, APR, and loan terms. Welcome to the Debt-Free Dreams channel. If you're struggling with debt or just want to make smarter financial choices, understanding key debt-related terms is crucial. In today's video, we're diving deep into 3 essential concepts that impact your debt: interest rates, APR, and loan terms. These terms are often confusing, but by the end of this video, you'll know how they affect your finances and how you can use that knowledge to manage your debt more effectively. Section 1. What is debt? Before we get into the specifics, let's quickly define debt. Debt is the amount of money you owe to lenders. This could be in the form of credit card debt, student loans, personal loans, or even mortgages. It's important to understand how debt works because managing it properly can significantly affect your financial well-being. Knowing the terms tied to debt can help you avoid costly mistakes and save money in the long run. Section 2. What are interest rates? An interest rate is the percentage charged on the amount of money you borrow, usually annually. It's a cost you pay for borrowing, and it's how lenders make money. For example, if you borrow $1,000 with a 10% interest rate, you'll pay $100 in interest over the course of a year. The higher the interest rate, the more you'll pay in interest over time. This is why it's so important to shop around for loans and credit cards with the lowest possible interest rates. Section 3. What is APR? Why should you care? Next, let's discuss APR, which stands for annual percentage rate. Unlike interest rates, APR reflects the total cost of borrowing, including both the interest rate and any additional fees the lender might charge. So, when you're comparing loans, APR gives you a more complete picture of what your borrowing will cost. For example, a loan with a 5% interest rate and no fees has a lower APR than a loan with a 5% rate but an upfront fee. APR is crucial for comparing credit cards, personal loans, and even mortgages. Section 4. Loan terms and repayment periods. What you need to know. The term of a loan refers to how long you have to pay it back. Loan terms can range from short-term loans, like 6 months or 1 year, to long-term loans that may last for decades, like a mortgage. The length of your loan term impacts both your monthly payment and the total cost of the loan. Short-term loans typically have higher monthly payments but cost less in interest over time. On the other hand, long-term loans have lower payments but end up costing more in interest. Section 5. How interest rates, APR, and loan terms affect your payments. So, how do these 3 concepts, interest rates, APR, and loan terms, work together to shape your debt payments? A loan with a low interest rate and a short loan term might have higher monthly payments, but you'll pay less in interest overall. In contrast, a loan with a high APR and a long repayment term may have lower monthly payments, but you'll end up paying a lot more in interest over time. It's crucial to compare these factors when taking on any loan to find what fits your financial situation best. Section 6. Tips for managing debt and minimizing interest costs. Now that you understand these concepts, let's discuss some strategies to manage debt and minimize the cost of borrowing. Here are 4 tips. 1. Pay off high-interest debt first. Focus on credit cards or loans with the highest interest rates to reduce the amount of interest you pay over time. 2. Refinance or consolidate your debt. Refinancing allows you to lock in a lower APR, which can save you a lot in the long run. 3. Make extra payments whenever possible. By paying more than the minimum payment, you can reduce your principal faster, which will lower your interest payments over time. 4. Consider a balance transfer. Many credit cards offer 0% APR for a limited time. If you have credit card debt with high interest, transferring your balance to a 0% APR card can save you money on interest. Section 7. How to compare loans and choose wisely. When you need a loan, it's essential to compare different offers to find the best deal. Don't just look at the interest rate. Consider the APR and loan terms to get the full picture. Tools like loan calculators can help you compare offers and determine which loan will be the most cost-effective over the long term. To sum it up, understanding your interest rates, APR, and loan terms is key to managing your debt wisely. By choosing loans with favorable terms and focusing on reducing high-interest debt, you can save money and regain control of your finances. If you found this video helpful, be sure to like, subscribe to Debt-Free Dreams, and share it with others who might benefit from these insights. And if you have any questions or tips for managing debt, drop them in the comments below.